And I've got a couple of things I'm going to show you here at the beginning of the webinar that I think you'll be interested in. First screenshot I took at babypips.com, which is a very, very good website for learning lots of things about technical analysis. I recommend babypips.com, especially if you are a beginner or intermediate in your understanding of indicators, just about everything having to do with charting and many other topics. But there's something that I'm seeing in the markets right now on a number of items, and I'll show it to you as we move through the webinar on a daily chart. And it's called Hidden Bearish Divergence. So hidden bearish divergence is where price does not make a new high, like for instance right here. Let's say that this was the February high in the stock market, and this was the March low in the stock market, and so we've made it back about 0.618%, and but it's obviously nowhere near the high back in February on most items, and then this would be an oscillator, a typical oscillator. For my example, I'm using the MACD line. I'm removing all of the other stuff like the histogram bars and the moving average of the MACD line. So I'm going to use just the MACD line, standard settings. And what we'll see is on a number of items is that the MACD line has actually made a new high above the high that it put in February in many stock market related items. This is bearish. And if you go to the babypips.com and you just search for hidden bearish divergence, and there's more verbiage there about it. But what they basically say is this condition of hidden bearish divergence, where the oscillator will make a new high, but price cannot, is something that indicates that it is time to for the downtrend to resume. So this would be a trend resumption. When to get back in the direction of the trend, and so that indicator right now is basically telling us that this. We're going to see a resumption of the downtrend, and we'll look at that on some charts in just a minute. So that's called hidden bearish divergence. Wanted you to be aware of that, and then also wanted to show you a composite line of, and we'll just zoom in here and maybe the S&P starting in 1950. Hurst nominal model, peaks and troughs considered, no repins. And what we're seeing is that the S&P is now labeling the February high with an 18-year cycle peak. And as I have been describing in recent webinars quite a bit, the composite line really only represents cyclic direction. When there's 11 cycles that Hurst takes into consideration, all the way from 5 days all the way up to 18 years on cycles, and the more of those 11 cycles that are pointing to the downside, the composite line will look to the downside, will be moving to the downside. And the more of those are, if the majority are pointing to the upside, they're coming up out of a large cycle trough, for instance, then it's projecting upward movement. The composite line does not project price. And this is frankly, the real difference maker in my work and work from others Elliotish, typical Elliotitions. For instance, right now we have the most mainstream Elliott wave organization that is counting this as a 1 and a 2, and we're ready for wave 3 to the downside now. And then there's another Elliott wave guy that is more famous for being bullish, and actually correctly called back in about 2010 that the stock market was very likely to move up and take out the 2007 highs, which is the largest Elliott wave organization missed that call. And it was about the time that, frankly, we did start moving. I think it was in 2013 when the stock market took out the 2007 highs that I started looking around for something that could help me not have a bias, have no bias, and help me develop wave counts in conjunction with Hurst analysis. That's when I first got into Sentient Trader software. It was probably about 2013 in Hurst cycle analysis. And it's been a long learning curve, I got to tell you, and it's to know how price is going to react at certain, especially major turns. And based on those years of experience, I've got some ideas that frankly don't really match either one of those guys. And the thing that I'm looking at is that with no repins, and I believe this is a perfectly correct analysis, by the way, with no repins, that was a large cycle degree top, that this was a triangle, and it's putting the 40-week cycle trough at the end of the triangle here on October 3rd of last year, and that this is not an 18-month cycle trough. It is actually a 20-week cycle trough, and we're likely going to move down into a large nest that is at least an 18-month cycle trough, and probably in the S&P, it would call it a 4.5-year cycle trough, which is a bit overdue. It's about a year overdue, the 4.5, but within each 4.5 years cycle, there are 18 months, three 18-month cycles, and the last 18-month cycle was at that Christmas low of 2018. So you move forward 18 months from there, and you really get into the middle of 2020. And you'll notice that the 18-month cycle trough, the price or Sentient Trader still believes, without any repins, that the market is going to move down into that trough. So the question becomes, is it going to move down in a wave 3 now? Is it going to move in a wave 3 to the downside? If this is 1 and this is 2, is this wave 3 of 3 and it's going to be aggressive in its move to the downside right now? And Hurst is suggesting that isn't necessarily the case, that we're going to get sideways movement. And notice that it's also suggesting we're going to get upward movement out of a July/August time frame up into basically early November. It almost nails the election date. The election that always happens in the U.S. in the first week of November. And so this is not suggesting we're going to get wave 3 of 3 now. Now, if you looked at this, it's not bullish either. It's not bullish like, for instance, Goodburn thinks that this is the end of a large degree wave 4, like perhaps an expanding triangle that started in January of 2018, or an expanded flat with an outsized wave B, which is actually his count. But anyway, he's got this as a 5-wave up structure for a 1, and we'd expect a wave 2 now. But look what happens after that. It just can't go much of anywhere. And so if I were going to try to figure out what this is suggesting in the future, I would say that this is a significant and major top, and probably the end of 5 waves up from the 2009 low. And this is a wave 1, and then we would get maybe an A, B, C up into November, and then we might start into the wave 3 to the downside at this at that juncture, and notice that this move to the downside is expected to be pretty much an obvious zigzag. So I utilize Hurst in order to remove bias. And here's the beautiful thing about it. Let's say you're in the Prechter camp or the EWI camp, and you think that the conditions right now are tremendously deflationary. There's bad news everywhere. This rise was a sucker rally, a wave 2, and we're ready for wave 3 to the downside. And the next thing we're going to see is a wave 3 to the downside down into. So what Hurst is basically saying is, if that's true, then it's going to have to put together a massive plunge to new lows and way below the March low if it's a wave 3. Probably down into the $1,500 range on the S&P, and it would have to do that by August, by July, August timeframe. And so it would be a very strong move down. If you're bullish and you believe this is 5 waves up and it's time for an ABC, then that's fine too. A person can trade both of those ideas by incorporating Hurst. Hurst is suggesting downward movement. If it turns out to be a bloodbath, great. You'll be on the wrong. You'll be on the right side of the trade. Here, it'll just move faster and stronger than what the composite line suggests. If it turns out to be a vanilla A, B, C to the downside for a bullish wave 2 down in here in March, and then that maybe this is wave 1 and it morphs up into November, and then it morphs into something a lot more bullish after that, great. You're going to be on the right side of the trade here. And so from that perspective, you don't have to care about, are we going to see deflation or are we going to see inflation? Which one? Yes, and John mentions the possibility of stagflation, and that's what I've been talking about as a possibility for a long time. That stagflation is something that Goodburn at WaveTrack, I just think he just figures that's impossible. Well, it's not. It has happened before. It's unusual. But in this particular instance right here, what we have is we have oil moving down to $6.50, $6.50 a barrel in April. And then we had silver and plunging to 7-year lows or something in March. And so from that standpoint, those items, those commodities are so profoundly low that maybe, we did get, as Goodburn believes, a very large cycle trough on commodities here in the March-April timeframe. And so his assumption is, if that's a large cycle trough, then they're going to move up together in an inflationary move. Well, not so fast, because the carnage that I think we've seen, and what if the bottoming process takes a lot of time to work through? So we've got this glut of oil, and just maybe there's just no real upside at this juncture. It just can't be supported from a fundamental basis, but maybe oil will never take out that $6.50 low. Well, does it have to create a V bottom? No. It could put in a long base and essentially a series of 1, 2, 1, 2s, and that is exactly what I think is going to happen based on what the Hurst cycle analysis is suggesting, that if commodities have bottomed, they are likely to put in a low base. Well, that is bad for the stocks, for companies that mine things or drill, because it appears to me that prices are likely to stay low for at least on through August on commodities. So is it possible that the stocks are caught in a situation where they cannot make money by drilling or mining at this juncture? Because many of these items are too low. Yeah, that's possible, and that the underlying companies may have a harder time and plunge while commodities base. That's kind of where I think I'm going with this. So I've gotten a lot of emails this week. It's like, wait, what if this is a 1 and a 2 and we're in a deflationary situation? There's a document, the monthly document came out, can't remember, Elliott Wave forecast, I think it is, Hochberg and Kendall, and that's exactly, they're extremely bearish, and they're talking about deflation all over the place, and it's going to plunge. And then the bullish folks are probably thinking, well, the Fed, which recently was essentially in the U.S. taken over by the U.S. Treasury, which answers to the president, has basically captured the power of the Fed, and they're doing some things that the Fed was never allowed to do, for like loaning money directly to corporations and buying stock, and that's going to prop this thing up. So there's two different, ways of thinking about this thing. One's bullish and one's bearish, and I think that it's possible that neither one can gain any real traction, and we might see a sideways business for a while until possibly things could clear up in about August. So that would be this low right here, July, August, and then the move up likely into November. So there's the forward roadmap. No, the fact is, this move to the upside, if you zoom way in, Ron, remember, the composite line does not project price, it projects direction. And that exact date of that peak right there is right exactly where the top we just saw. So don't worry, this is the thing you have to get used to in Hurst, is you just because that composite line is standing way up there, just because it's way up in here, that actual date when I hover over that on an actual analysis is basically exactly where we topped on Wednesday of last week, and therefore the downward direction should continue basically for the rest of the month. Exactly. You can be on the right side of the trade, based on Hurst. You just don't know how far it's going to go. As far as, when you start trying to determine how far it's going to go, that's where you look at internal wave structures, develop an Elliott wave count, and develop Fibonacci price targets. So that, I think, is a fascinating roadmap that moving forward that we'll look at. And so let's start counting the waves. So my main count is the 5 waves up in the stock market from the 2009 low is complete, and we've started into a multi-year bear market. And then as we move into the monthly chart, you can see the position on the Dow Jones Industrial Average is not July, August, it's slightly even later than that, September. I've been talking about that large cycle trough that's sitting in about mid-year, slightly past, for how long? over a year. But this is Hurst, in my opinion, allows you to see around corners and see into the future, especially when it comes to the 18-month cycle. So there's three 18-month cycles within each 4.5-year trough. So there's a 4.5-year trough there, and there's an 18-month cycle here, another 18-month cycle here, another 18-month cycle here. In my estimation, it is not complete. I one of the longtime subscribers pointed out to me that David Hickson is potentially trying to call the 9-year cycle trough in place. And I addressed that last week. If you need a reminder, go back and look at the first half hour of last week's webinar, where I forced pinned the 9-year cycle trough to the March low, and it still wasn't bullish like it was going to move on to new highs. It still projected this sideways business. Why? Because it's convinced that that's an 18-year cycle peak. As I just showed you, the expected move to the downside next move is to the downside next, moving into the daily. Okay. So I sent out an email as soon as we got price peaking slightly above this high back over here on April 17th, and said, we may be getting a fifth wave up. Well, if this is a 5-wave up structure, and that is not a foregone conclusion, if this is a 5-wave structure to the upside, it's an unusual one, because wave 1 is the longest, so it doesn't happen very often. And 3 was shorter than 1, and then 5 was shorter than 3. So it would be an unusual ABC structure. I'm sorry, unusual 5-wave structure to the upside for the stock market, where wave 3 was not the longest. So what else could it be? Well, I know Elliott Wave International has got this as an A and a B, and then a 1, 2, 3, 4, 5, an ABC structure. Yeah, it's possible. It would be also a WXYXZ, although I think I can see a pretty clean 5 waves up inside of this, especially this wave 1. So after that, now I'm going to take it out of Similog just for a minute, because if I draw Fibonacci's, when the chart is in Similog mode in Trade Navigator, sometimes it crashes the platform, and I really need to call them and tell them that, so they work on that. So now I'm going to put it back in Similog mode, now that I have a Fibonacci I'm drawing on here. And if there was going to be a relationship with 2 through 5 to 1, or no, if this was going to be A and B, then C would have had to have hit 25.17 in order to be equal to. And so that Fibonacci didn't work. And there's one other one I can do, and that would be the Fibonacci expansion. So I'm going to take it back out of Similog. And I'm going to look for expansion. So many times, if this is wave A, then you would look for a B and a C, and you look for the C wave to end at one of these Fibonacci targets here on a Similog chart. So I'm going back to Similog. And there is an interesting situation, and that is that the rest of the impulse only moved up to the 0.382 expansion off of this move to the upside. So is it possible that this is an A and a B and a 1, 2, 3, 4, 5 for C, and it's not a 5? According to Fibonacci, yes, that may even be the preferred count. And if so, this would be a corrective move. And therefore, it's worth considering that this was, and I'll use this as the double question mark, this was a wave 1 in 5 waves, and this was a wave 2, because it's up in 3 waves. And if that is the case, then we would get basically a deflationary crash, 3rd wave down. Next, what other evidence is there what other evidence is there that the trend is down and the up move just gave us a signal that it is time to plan for a resumption of the downtrend? And here it is. This is a MACD line. It's standard settings, 12 and 26. And I have colored it so that when it is moving down, it is red, and when it is moving up, it is green. And we just saw what happened. I placed a line at and I measured the exact number at what the high was in that MACD line at the February top, and it came out to 196, and now we have the MACD actually pushing higher than it was at the February high, even though we really haven't we've only retraced about 0.618 of that move. That is bearish. That is a hidden bearish divergence. And it's not a divergence that people typically look for, but those that do look for it find that it's very unusual, and it can be a strong signal that the trend, the former trend, is about to resume. So that also supports the idea that this move to the downside, we'll just have to see how aggressive it gets. If it gets real aggressive, and and by the way, the composite line, when I look at really zoom in on it, it looks for a little low here on May 3rd. That's basically today, and then a little bit of a rebound through May 7, but very little, not much of a rebound, just a very small little bump, and then more downside. And the move down on Thursday and Friday was pretty impulsive. I was looking at on a fairly short-term chart, and it was showing 5-wave down structures and 3-wave moves to the upside, and it was having a hell of a hard time finding any buyers on Thursday and Friday. So so just remember, and in my work, essentially, I'm looking to the downside next into late May, early June. I'm looking for a rebound, I would say mid, or I've drawn it with taking a little bit of leeway there, that it's probably going to be over here, that it tops in, let's say, late June. And we'll look at some other items besides the Dow and what the Hurst is projecting for this rise here. But at least for now, The composite line is bearish. It is bearish down in pretty much for the balance of this month. So I think the entire month of May is generally going to be to the downside, and I think that the right side of the trade will be on the short side for the month of May. And then we'll see if this creates a 5-wave down structure. And look at what the fast divergence indicator is showing. And I'm going to point out another thing about this fast divergence indicator, which I should show on for premium plan members, on every algo signal chart with my proprietary AMA plus WB algo. And that is, it is a more powerful signal. Divergence is a more powerful signal if it crosses over the zero line. If it crosses over the zero line, and I'm going to try to make this zero line a little more prominent. And if it crosses over, comes back up, price makes a new high, like I did here early in the week last week, but the indicator is unable to make a new high. So this, when this falls through and makes a new low below this low here, then then we'll notate it on the charts for the premium plan members for that night, and that will create a divergence, a bearish divergence sell signal on a daily chart. And so this one back here created a little bit of downward movement, but not enough. And then it snuck up and made a new high. But now we have what is essentially a double divergence. And the second one should be more powerful because it crossed over the zero line and then back above. When I wanted to make sure I made the point about Hurst and the fact that what Hurst is basically saying is we're going to see downward movement next through May. So then what I do is I take that and I try to develop a forward Elliott wave count on it. And in a way, I don't have to care if my Elliott wave count ends up being perfect or not, because at the proper junctures, I think that it allows you to be on the correct side of the trade. You know, whether this is going to be a weak move down or a strong move down doesn't make a whole lot of difference. We're looking for down into this 80-day cycle trough. And if it ends up being really strong and you're on the right side of the train, great, make a lot of money. If it ends up being weak, it might be slightly disappointing, but you're still on the right side of trade. Should be a profitable trade. Boom. Moving to the S&P. Let's look at the sentiment. We really have the commercial sentiment still heavily long on the Dow, but I really don't put a lot of weight behind commercial sentiment on stock market. I do on commodities. It's very important on commodities, and I just don't think it's very important when it comes to I think the much more important sentiment indicator is the DSI, which we don't really have on the Dow Jones. I've got a synthetic version of it, but we'll look at that on the ES contract in a minute. So on the S&P, I believe the 5 waves up is finished from the 2009 low, and in my count, because I'm counting that as a wave 1, at cycle degree, we're going to get a big multi-year cycle degree wave 2, multi-year, lasts down into probably 2024, 2025 time frame. This initial move to the downside, I'm going ahead and labeling with a wave A. And alternatively, I've got it as the end of a wave 4, and it would move on. We would move on to all-time highs. An expanding triangle for wave 4, basically. So there's the main and the alternate, and notice that the next thing that Hurst is expecting is a move down into July-August timeframe. So here's another way to look at what's going to happen over the next year is, and this kind of would exemplify a constant battle between the global central banks and a deflationary environment that would go on for a while here. And I think it's realistic to consider that the global central banks will not be able to really create a massive move in a fifth wave up, aggressive to new highs for a while, as the deflationary situation is fairly dire at the moment. But they might be able to kind of put a floor in it, and that's about all they'll be able to accomplish, and they'll be emptying their coffers, trying to even get that accomplished. And therefore, we might get a sideways move, very similar to what the composite line actually visually looks like that I showed you at the beginning of the webinar. So on the daily chart, I'm expecting a move down next into early June, a rebound into mid-June, and then on down into July-August timeframe next. Notice I could see this very same hidden bearish divergence where, despite this move to the upside, being way short of the February high, the MACD line actually made a new high. I was shocked when I saw this just happened onto it, and I thought, man, that's a hidden divergence, and it's bearish. So I'm also going to put basically another potential count on here, because I already showed you the possibility that this up move is not a 5, it's a 3. And notice I took that composite line that was shown on that chart, and I held the mouse over it and looked at the exact date of the highest point of the composite line, and it was April 29. And the date of that is the exact date of the high so far. And so this could be an A, B, C. And suffice it to say, though, if that's correct, it's going to absolutely have to get crushed. Crushed next. Why? Why would it get crushed? Oh, yes, thank you. What do I mean by getting crushed? What does that mean? Well, draw Fibonacci so you'll see it. Just trying to avoid crashing the platform here, and then so typically a wave 3, just a very common wave 3, would be 1.618. Oh, yeah. 1.618 times the length of wave 1. So I'm going to put this back in Simulog mode. By the way, just because your chart's in Simulog mode doesn't mean your tools draw in Simulog mode. So you'll notice something here in just a second, that I have something checked here, use Simulog for drawing tools. So just because you have your chart in Simulog mode on some platforms doesn't mean that your Piyush, I've been explaining this all along, that this could be an ABC to the upside. This move to the upside could be an ABC. And so if it was a wave 3, the target would be 1456. 1456. Okay, all that being said, what I'm really showing you is that if this is going to be a move to the downside to 1456, it's going to have to do it by July or August, and that is why I haven't been showing it on my charts. Because it doesn't seem likely that it would crash that precipitously, that quickly. It would have to go like this. And that, to be perfectly honest, that if you're going to count this as a 1 and a 2, then that is your expectation. And when we combine that expectation with Hurst, that would be the angle of descent. True, Jack. That is not inconsistent with recent volatility. It's and so that's why I'm not completely counting it out. I mean, it seems unlikely, but there's no way I'm going to count that completely out. It's not my first or second preferred count at this juncture. Here's the way I look at it. I'm calling for downward movement. If it's really strong, I've got a chance to change my count to that. And my subscribers will be on the right side of the trade anyway, if they're trading my analysis. So there's the way I'm looking at the markets. I'm expecting downward movement between now and July, August, possibly September timeframe, and I'm leaving open the possibility that it's a crash. So I'm going to put that is the double question mark count, and put the target at 1456. Yeah, there's some interesting developments. I mean, you look at what the news that just came out on Warren Buffett. He managed during this move to the upside to sell all of his airline stock. How did he do that in a relatively stealth manner? And then we only find out about it now. He's already got it all sold. It's almost like the guys that can really push this market around, push this thing higher on the indices while they were dumping their worst stocks in just gradually in as stealthy of a fashion as possible. That's what it sounded like to me, what they just pulled off. Could be. I do have some large institutional subscribers. I do. I know for I only have one that admits to me who they are. And here's the other thing. Yes, I'll agree that COVID has exacerbated this move to the downside. However, I was calling for this to happen at that top before COVID was a thing. I mean, I was looking for a top, really a major end of the five-wave up structure from the 2009 low. So, and I was looking for that as early as November. And I just was looking for an end of this terminal thrust out of the triangle, and I felt like that would be it. Now that thrust ended up lasting a little longer than I thought, but there was no COVID. I wasn't thinking about COVID when I was saying that we're just about finished with five ways up, and there was a lot of excesses in the market at that top, and but for COVID to come in at that time. So I don't think this move to the downside is all about COVID, but I do believe COVID has exasperated things and made things obviously, much worse than what they would be without it. So here's the daily chart. So once again, I'm going to call this a potential A. I know I've got 3 counts here, but this isn't a problem having 3 counts, as I have been saying, because with Hurst, we feel like I feel like there's going to be downward movement down into August. So, but the main count is that we moved down in a zigzag down through August, and it's a substantial move. Even if it just moves down to this support level down here, that's still over 13% move down in the market, and that would be my main and my alt. Whereas my double question mark count is the potential for a plunge much lower. So right off the bat, looking to the downside down into late May, early June. Notice on the daily chart the hidden bearish divergence on the S&P as well. So this is, if I was going to get into the nitty gritty of what I'm seeing in the composite line, it's down through about now up through just May 5th. That's Tuesday. So we may get a little rebound here. But I think the top is in, pretty convinced that we have a top. And that we're going to move down next into early June next. And it could be aggressive, or it Might not be in the very early juncture of this move to the downside. That's pretty relentless leg, and I would expect that leg to make it all the way down to the wave 4 here. That'd be back to 2717. Is that right? 2717, and that's why I've taken the liberty of thinking that it goes ahead on down for maybe a day and a half. Rebounds. Who knows? Maybe 50% of this move down, maybe less, and then it's on down. We have a potential of a divergence sell signal coming up for premium plan subscribers. It's probably going to happen Monday, Tuesday, Wednesday of this week. You know, this line, even if we get a little bit of a bounce, once it turns over like this and starts heading down, it generally continues lower. It might take a couple of days in order to provide that signal. And notice that it just got out of a long position at a small loss, and the next thing it's probably going to do is take a short signal here pretty soon, and that seems like a good signal to take. Sentiment, the commercials are still showing heavily long. I think the commercials have a way of gaming these positioning indicators. It's a liar's world now. Liars and cheats. And if we get into a real crash here, yeah, I would expect more lying and more cheating. The last attempt at a long position on the bullish SSO, 2 times bullish ETF, was immediately stopped out. And notice the potential over this bearish divergence developing. It has to cross over the indicator, which is basically a divergence indicator applied, or momentum indicator applied to a MACD indicator with specific settings on each. Once it breaks through that low there, then I will have a sell signal on that. Same thing with a buy signal on SDS, pro shares 2 times bearish. So this would be one way to short the market, and it looks like this indicator is likely going to move on up and create a bullish divergence and so when you buy shares of SDS, you are shorting the market. I've been tracking just for fun this RSP, the S&P equal weight ETF. You'll notice on that one, let me get back to the regular ES. On this one, you can see price snuck up a little bit above the 0.618 retrace, but on an equal weighted basis, the S&P was unable to reach the 0.618. So that indicates just a very quick comparison of those two, just shows that there's the larger stocks are still dominating price to some degree. And I wanted to come up with there's a new item. This looks really interesting that I wanted to bring to your attention. It's an ETF called HDGE, and this is not an ETF. The HDGE is an ETF of specific stocks that a couple of money managers have chosen to short and they're not shorting these items by through derivatives. So this item would not have time decay, and characteristics like your typical 2 times bullish or 2 times bearish ETF, where you know, you don't want to hold on to those leveraged ETFs in a potentially sideways environment. And what you do with those is you hold them for a few days, maybe, you know, a couple weeks or something max, but a few days. If you think you're going to have a fairly strong move for a few days, that's where those 2 times and 3 times bullish and bearish ETFs come in. But this one, the money man, and you might look it up, HDGE, the money managers are actually really shorting the stocks. And so there's no derivatives, no options, no futures. They are, and in order to short stocks, you have to have a lot of money in your account, and it's just the old-fashioned way of shorting the stock, where I guess you're reserving some buying power to buy the stock later, but you are shorting the stock now. So no, I don't believe they're using futures. And so this is a really interesting item. Now, it doesn't have the volatility. It doesn't have the volatility that the 2X items have, but it is something that if you have a pretty large count and you're long some stocks, and they're good stocks, and you want to hold on to them for the future, and you've held on to them for a very long time, and they've made you a tremendous amount of equity in your account, and you don't necessarily want to sell them right now until you see what happens later. You could buy shares in HDGE, and they only short stocks that probably are going to have the most difficult time in the current environment. So they're probably not shorting, you know, the stocks that have been leading the way higher, you know, the big names that would survive in virtually anything. An example is, I think they've been shorting the airlines. And so notice we got a nice bounce the last couple of days, but just look into this one. I'm going to track it. Here's another thing you could do with this one. Because it doesn't have the time decay element, you could add the time decay element to it by playing options on it. There are options available on this, and it's not really an ETF. I think they call it a trust or something. Officially, it's set up like a trust. Anyway, interesting item. And if any of you are really interested in this and find out some information about it that you'd like to share with the group, you do that in the chat maybe next week.